right. Hi, everyone. Welcome to the first ever episode of Word on the Street, presented by Warren Street Wealth Advisors. And I'm Philip. I'm the portfolio analyst for the firm, and I'm also one of the hosts of this show. And with me, I have Blake. He's the co-founder, chief investment officer, Valorant player by night, and pickleball player by day. So a ton of different titles you can give this man, but definitely one of the smartest people I know. Also one of the co-hosts of this show. And this is going to be the start of a series of micro-sized podcasts where we aim to just deliver some more content around what's going on in the economy, what's going on in the market. So definitely, if any of you have any topics that you would like us to address, definitely let us know, and we'll try our best to cover those. But Blake, how's it going?
It's going good. I'm excited for this format. I think content production is always difficult when we overthink and over-prepare. So looking forward to just kind of shooting from the hip a bit more and just playing it a bit more loose. And I'm excited.
Yeah, exactly. But again, micro-sized podcast, that's what we aim to deliver. So I think we're going to jump into today's topic, which is inflation. And I know I've seen it all over media headlines, whether that's CNN, NPR, MSNBC, but I don't know, some people say like fake news, that's a term that was coined a few years back. Do you think all these inflation reports are fake news? And what do you think?
No, I don't. I mean, it's obviously, in front of our face, depending on where you're shopping and how you're spending your money and living your life. For me personally, as a young father of 2 kids, it's hit me most at the grocery store. So the other night, realized we're out of milk, ran on down to Albertsons, and an organic 2 gallons of milk cost about $10. Pre-COVID, I want to say that same bottle of milk was about $5.49, which is still stiff and expensive. But I mean, it's definitely sticker shock. So I'm not the kind to complain over nominal price increases. When I go to the pump these days, even in the state of California, I know people are crying foul, but I honestly, it doesn't register all that much. Maybe because I drive a Prius and I don't drive a lot. But there's definitely inflation and a lot of different core categories and not so core categories. I think the question remains for most folks is how serious will it get and how long will it last?
Yeah, exactly. I don't think the jury's still out for this one. I think the verdict's pretty clear that inflation has hit the economy. I mean, I was telling Blake a few weeks back that I went to go eat some sushi with some friends. It was all you can eat sushi, and pre-pandemic, they were charging me $25 a person. Still, I would say pretty reasonable, I guess, for all you can eat sushi. But when I went to catch up with some friends this time around, they were charging me $40. So, being raised in a frugal household, trying to save expenses, I just felt like I was paying up an arm and a leg. I was telling Blake 2 weeks ago. So frugal. But discipline, sure. But yeah, exactly. Inflation seems to be top of mind. And let's take a look at what the data says exactly about inflation. So if we look at this chart, and over here on this chart, we have pretty much something called the Consumer Price Index. It's basically a measure of price change for a basket of goods that is representative of consumer expenditures. So within this basket, you'll have things like groceries, as we were talking about, energy, depending on which type of inflation measure, headline or core consumer price index. The headline measure will be inclusive of agriculture and energy, and then the core will kind of strip that out just because the headline figure and being energy and agriculture, it just creates a lot more volatility to that inflationary measure. But basically, if we look at this data, you'll see that for over the past 10 years or so, it does look as if inflation remained pretty muted for the most part. And then suddenly you get this massive jump in what seems to be 2021, where year-over-year inflation, which is basically comparing prices or price change from today compared to a year ago, it just seems like, towards 2021, the inflation measures really just jump off the roof. But Blake, can you kind of tell me why you think inflation was kind of muted for the past 10 years and suddenly why we're getting this massive increase?
Yeah, I can remember back to, pre-Great Recession, being in school and starting to study, the impact of globalization. And I remember learning kind of the phenomena of importing deflation. And, if you think back to buying a big screen TV in the 90s, how much it cost you then versus how much it costs you today, there are a lot of household goods that are less expensive today than they were decades ago. And that's obviously not true of every single consumer category. But globalization has, lowest common denominator, favored capital flows, and imports of products that, are low skill, low wage required. to overseas markets, and then we bring that back home. Prices are falling in a lot of categories. So we've gotten very accustomed to prices being stable, sometimes prices falling. I remember the same class of car that I was buying as a first-time driver. Fast forward 10, 15 years, it's almost the same exact price point. And so that's obviously the impact of automation and manufacturing and technology. So we just got really used to stable prices. On the other side of the coin, wages are obviously a major driver of inflation, and we haven't seen a lot of wage inflation for quite some time. Hard to pass on rising costs to consumers that are not taking home more pay. So it almost serves as like a stint in runaway inflation, if you will.
Sure. But what about this year, right? I mean, you talked about seeing those grocery prices increase. You're at the pump and you see those prices rise. I'm at the restaurant, I'm like, oh my gosh. But what about it? What is it this year that's causing all that inflation? Is it coming off really depressed levels? Is it supply chain issues? What do you think it is?
I mean, the two things that jump out most to me are certainly supply chain, disequilibrium. You had a lot of products or services that, overnight saw exponential increase in demand or a complete zeroing out of demand, which affects production and, materials and input costs. And at the end of the day, no one can predict when those things should or could or can come back online. So for example, within hospitality, whether you're talking about restaurants or hotels, a lot of places just flat out went out of business. A lot of vacations were deferred and or canceled altogether, which creates over time a pent up demand. And so when consumers kind of return to the fold and everyone is just anxious to get back out there and spend some money at a restaurant or go on a vacation, but at the same time, there's no workers to serve the meals, to cook the meals, to turn over the rooms, to staff all these facilities. All of a sudden, you've got a lot of demand and not a lot of supply, which obviously would put an upward pressure on prices. So there's certainly the supply chain disequilibrium. I know we're going to talk a little bit later about the Great Resignation and folks kind of reassessing, what they do for a living, and that has an impact on wages as well. And when wages are rising and people are more mobile and voting with their feet and asking for more money, that obviously too can have a direct impact on inflation and passing on prices. So those two things, I would say, the supply chain equilibrium and the Great Resignation, if you will, have been the primary drivers.
Yeah, I completely agree. And I want to read off some really quick high-level numbers, just an example of supply chain issues, because that's very vague. I figured that this example I'm about to share is an embodiment or a proxy for what the supply chain issues really are. And the example I want to share is actually the Port of Savannah, which is actually the US's third largest port. And credit to this New York Times article that we found, but here are just a few really quick statistics. You have in October 80,000 shipping containers stacked in various configurations at the Port of Savannah, and that's 50% more than what the usual is. So I would assume that you got to figure out how to stack all these different configurations. I would think that whoever's stacking that must be like a genius Tetris player. I'm terrible at that Tetris myself.
I'm pretty good.
Oh, okay, there you go. Another really quick statistic: you have 700 containers just left at the port for more than a month, and these containers aren't being picked up and being brought to warehouses. They're not being picked up and being brought to where they're supposed to go. So they're just stuck there, either because there's a shortage of truck drivers to bring them to where they're supposed to go, or maybe they're just in the wrong place, right? So that's kind of another example. A record average of 92 days for manufacturers to assemble their parts and raw materials in order to make goods. So you have to wait 3 months just to get your supply chain started, right? So that's kind of the supply chain issues that we're really seeing, and just putting some more context around that.
92 days. Do we remember from looking at the data what was normal? What was average?
No, I did not get the average, but
I think it was in the teens, if I recall correctly. So, I mean, that is the definition of a bottleneck, right? And this is anecdotal, but I'd seen a Twitter thread recently where someone like chartered a ferry through, I believe, the Port of Long Beach or the Port of San Pedro, and basically just like observed what was going on within the port in terms of just abandoned cranes, container stacked on containers, clearly empty, no labor on site processing, which matches what's happening in terms of the disruption. And so when you've got, an excess of some inventories, Other inventories can't be replaced fast enough, not enough workers to do the throughput and the processing. If they do process the product, can they get it, to where the end game needs to be, and into the consumer's hands fast enough? So that is disequilibrium. Obviously, COVID turned the entire world on its head, and that's just going to take time to flush itself out.
Yeah, exactly. And it's hard to say how long these supply chain issues are going to continue, but I do think it's important to remember that these supply chain issues are a symptom of COVID. And now that COVID is trending in the right direction for the most part, I would be more optimistic than pessimistic, but obviously remains to be seen.
Yeah.
But we touched on supply chain issues. The other topic I want to touch on is something called the Great Resignation. And in the 1930s, we had something called the Great Depression. 2008, we had the Great Recession, the Great Financial Crisis. 2020, people are calling that the Great Lockdown. 2021, they're calling it the Great Resignation. So I feel like the time frame in which you call these things great is just getting shorter and shorter. So I'm just waiting on the day we get the Great Orange Street Wealth Advisors. Maybe that's imminent. But over here, we just want to share a really quick few charts about labor shortages and wage inflation. More so labor shortages than the latter. But basically, the chart you're seeing right now is representative of the number of US job quits per month. And in August of 2021, 4.3 million people quit their jobs. And that's the highest in recorded history. And if you look at the total quits rates, we do also see the highest in recorded history as well at 2.9%. So I don't know, Blake, why are people quitting their jobs? How is this funneling into wage inflation? What are your thoughts?
Yeah, I mean, early on in COVID and up until even of late, you've heard a lot of folks blame labor shortages on, the hand of the government and unemployment and expanded unemployment benefit programs. And as those have kind of been curtailed and clipped off, the data has not reversed course, and folks have not suddenly reversed or returned to the workplace in droves. I do think there's something to be said for certain segments of the economy being impacted by that. But we have to remember, public health crisis, pandemic was real. Folks that worked on the front lines, whether in public health or in hospitality, in mass gatherings and things like that, had a right to stay home and be kept safe. And it's not a simple science to get them all back to work at the same time. But I think more important than that, folks were afforded months, longer than a year potentially, to stay at home, to reassess their lifestyle, to reassess their careers and their education, and really given time to think about what they do to earn a living. And so for a lot of folks, that were maybe close to retirement, it was an ample opportunity to reassess and potentially make that decision. For other folks, it was, they've been contemplating a career change, and this was the moment. They were able to be geographically mobile. The remote workforce was really, birthed and exploded during the COVID era. And so the ability to be able to work from pretty much anywhere makes you much more hireable in a lot of different places. So you're no longer searching for opportunities just in your local geography and proximity. You now can canvass the entire job market, across the nation, across the globe. And so that just leads to a lot of worker mobility. So those are just a couple of factors. For me, that's, I think, the biggest one is when I'm talking to young people, especially, well-educated, highly talented, and in demand, if you are requiring them to come into the office 5 days a week, it is a non-starter for a lot of folks. And sure, that's anecdotal, but I hear that from a lot of business leaders. There's an expectation in the workforce today to be able to adapt and offer or support, if not remote work, at least hybrid work.
Sure. Yeah, I mean, it seems like the power is going back towards the hands of the workers in a way.
Mm-hmm.
But I think the biggest thing I took away from what you said was it's not just one cause that's causing all these quits. It's multiple reasons, whether it's early retirements or people that are still worried about COVID, or some people are staying home to take care of the kids. So yeah. I think it's definitely hard to pinpoint whether this is going to be something structural and sustainable moving forward, where we're just going to see a ton of people continuously quit. But definitely no certain cause. So I definitely don't think you can say that this is going to be something that's going to be for sure continued into the future.
Yep.
But yeah, now that we talked about supply chain issues and also people quitting their jobs, leading to these higher wages at the end of the day, I want to touch on something that Jack Dorsey said, which I think is pretty interesting. I'll read it really quickly. Jack Dorsey, I'll let Blake introduce him shortly, but he said that hyperinflation is going to change everything. It's happening. It will happen in the US soon, and so the world. Quite a bold statement. Can you introduce who Jack is? And maybe your own sentiments there, Blake?
For sure. So Jack Dorsey, CEO of Twitter and Square, bit of an eclectic dude. Hard to mistake him once you get to know him and get to know his beard. It's interesting. I think to start with, making macro calls on the economy globally, domestically, is really difficult. There's a lot of smart people in the world who have tried and failed, over the decades. And so for Jack and the positions that he's in to try and make a macro call of hyperinflation, it's a bit of a reach, I think, to start with. Only time will tell if he's in fact correct. Obviously, Jack being a little bit out there and a crypto bull, and he has his own biases as to why hyperinflation might play out. To get clear on what hyperinflation is, I mean, the accepted academic kind of perspective on it is 50% inflation in recurring terms. So some folks will say monthly, but economies that are actually experiencing hyperinflation are basically headed for economic ruin, and their fiat currency being devalued and virtually worthless in due time. So I just talked about casting doubt on macro calls. I'm not an expert in making macro calls either, but I think it's as likely that we see deflation as we do see runaway inflation over the long term. Everyone's talking about runaway inflation and rising rates. The prospects of falling prices and falling bond yields and seeing negative real bond yields like we see in Europe and other economies around the world is certainly still a possibility. So as the kind of COVID normal kind of works its way through the system and the supply chain disruption work its way through the system, and the Federal Reserve's quantitative measures that they've been implementing kind of wear off, there's a strong chance that we obviously don't see hyperinflation, but we don't even see kind of runaway inflation that it persists for an extended period of time. So anything is possible. I just think it's important to not get too worked up and pretend that just because COVID distorted things, that they will always be distorted. And
Sure.
Probably a little bit longer than you were hoping for there.
Yeah, no, I definitely want to jump in here because it sounds like you, based on the monetary and fiscal policy measures, I mean, you did also mention things like quantitative easing and whatnot. It seems like you have faith in our monetary and fiscal policy, our central bank, to be able to control this type of a scenario, raise rates when possible or when needed. And in my personal opinion, I feel like I've seen the word hyperinflation being used in the media a little bit loosely. It seems like it has gotten away from that definition. But typically, we do see hyperinflation during periods of extreme political instability. And usually, I mean, just previous examples that we've seen, it's usually coming after periods where there's a war and now you're trying to print a lot of money in order to fund that war effort, or you owe a ton of money in foreign denominated debt. So one example I like to just remind everyone about is the Weimar Republic, which was the German government set up after World War I. And after World War I, the United Nations had deemed Germany pretty much responsible for the war, and they demanded very heavy reparations from Germany. And obviously, Germany's economy after the war wasn't necessarily booming, and they did have a bit of trouble paying those reparations. And that eventually led to them printing a lot of money to a point where a loaf of bread was worth 4.6 million marks. So, quite the change, right? Quite the shock there. But at the same time, you'd also go down the streets and you would see kids just making pyramids out of currency just because of how essentially worthless it became. And sometimes I like to remind people of that example because I feel like the media has gone a bit further away from these previous historical lessons. But that's hyperinflation.
Yeah,
don't think it's likely.
I think we're a long way off from post World War I Germany, and at the same time, it's really important to keep in mind that we did just go through a global pandemic, which was unprecedented, for people that are alive today, and it's going to have, a transitory and in some cases maybe a permanent impact on the way we live our lives and we view capital and we view labor. But I'd also think that there's a strong analogy and something I've experienced personally recently, which is Peloton. Gym shut down, locked in your house, needed to have a new answer for lifestyle. I bought a Peloton, spent $2,000 on it, signed up for a membership on it, riding, trying to get into it. Company stock goes wild because I'm not an anomaly. There's a lot of people thinking and behaving just like me. Pulled a ton of growth forward. You could argue that there was an inflationary pressure created by some type of disruption within Peloton's business model. And if you looked at the Street's, forecast and analyst forecast for how well this company was set up to do, everyone overestimated, kind of shot the moon, and it became Wall Street's darling for a period of time. Fast forward to today, that story has exhausted faster than anyone might have thought, which people are now going back out into the world. They're signing up for their local gyms. They're getting back into classes. They're not riding their bikes. They're taking less classes per month. They're selling their bikes in the secondary market for 40 cents on the dollar, which I'm trying to avoid, but I'm pretty sure I'm close to, because I don't really love it. So that is a disruptive example of what a global pandemic can do on a micro level of one company and their supply chain, and supply and demand dynamics. That's playing out obviously on a global scale in every facet of our lives. So don't always anchor to the moment in time of when things are unstable or unsettled. These things have a way of working themselves out, especially when there's economic incentives involved.
Sure, absolutely. Well, I get to know that Peloton bag is soon out of the way, but you touched on a stock that, you could argue that benefited from the pandemic, and I don't know what the exact inflationary impacts on Peloton was, but can you, from when it comes to inflation, right? How should we be approaching this from an asset allocation standpoint, from a portfolio construction standpoint? Is it something where, oh shoot, no, there's inflation, like we just sell everything and run for the hills? What kind of strategies can we leverage, or how are you thinking about this from a portfolio construction standpoint?
Yeah, so I think it's important to note that no one asset always works. Even when you talk about inflationary environments, if you look back and measure kind of each period of inflation over the last couple of decades or the last 100 years or so, it's not as if there's this one magic aha type asset that will work. However, there are kind of common properties within assets that tend to hold up better within inflationary environments. So starting with kind of the 800-pound gorilla in the room, when you're investing in stocks, you're investing in corporations. Those corporations have earnings or cash flows. There are certain segments of the stock market that have the ability to pass on the effect of inflation to their end consumer. So even though their input costs, their materials costs are rising, they are able to then take those costs and transfer them off of their own P&L. So there are some segments of the stock market that actually do just fine or even quite well during an inflationary environment. You always got to be mindful of kind of the elasticity of demand within those different sectors and economies. Bonds, the next kind of staple in an asset allocation, definitely in aggregate don't hold up well in an inflationary environment. Long story short, you're loaning money for a period of time and getting a fixed interest payment. If inflation is running away, chances are rates are rising. When rates are rising and you have a lower coupon paying bond, that affects your bond's value. So in an inflationary environment, you got to be very mindful of your bond risk and how long you're loaning money out. There are other areas of the investment universe or landscape that do quite well. So real estate stands up to do well, especially if you have leverage involved and are borrowing money, simply because you can raise rents. And that doesn't mean just on the rentals that you own directly, that also plays into the REITs and the commercial properties and things that can pass on the rising costs to their end tenant. Things like commodities, futures contracts on commodities, metals, industrial, precious metals, agricultural metals, energy. There are a lot of other aspects, especially hard assets, physical assets, that benefit from inflation because as purchasing power decreases and prices rise, those things are passed on directly to the end consumer of those things. So you'll know this, maybe I'm getting ahead of myself here, but those are things that we're mindful of as this inflationary pressure builds, is probably being overweight equities, probably being overweight diversifiers or lesser correlated assets to equities and fixed income. And then within fixed income, being very careful about who we lend our money to and for how long.
Yeah, exactly. I think what I took away from your kind of spiel right here, just about the asset classes and performance during inflation, it seems like there's, going back to like a sports reference, because I played sports growing up, there's an offensive way to tackle inflation. There's like a defensive way to tackle inflation. Yeah. The offensive way, you're talking about investing in companies or types of stocks that will be able to pass the price increases through to the end consumer, whether that be energy companies. From a financials company standpoint, financials might do well just because as inflation starts to pick up, the Fed will raise interest rates, and typically during higher interest rate periods, banks will be able to earn more net interest margins. But those are just very minor examples. As to the offensive side of it, it seems like the defensive side might be something like a gold, more of a store of value that will keep its value where it is compared to if a currency during an inflationary time will actually lose in value. But I think those are the asset classes that we can move forward with. But at the same time, we warrant advisors, we've made a few changes in our own portfolios where at the start of the year, we actually invested in global natural resources ahead of this whole reflation scenario. And since then, or since that trade, it's been quite rewarding. We've also invested in the likes of commodities to also reap this reflation narrative as well. And bond changes. We've underweighted bonds in our blended models. So to Blake's point, you want to be careful about your bond exposure and also what kind of who you're loaning your money out to for how long. So those are just a few courses of action that Warren Street has taken in terms of tackling inflation with asset class and portfolio construction.
Yep. Well said. And we have a lot of conservative and older clients that own a lot of bonds. This is not a give up on bonds as an asset class and run for the hills, but when we say be mindful of who you're lending money to and for how long, there's a different level of interest rate risk in loaning the U.S. government at historically low yields, for 15 years at a time money, than loaning a corporation for a shorter period of time at a higher yield money. Because at the end of the day, when that bond matures, you get your principal back and you can reinvest it. So if rates are runaway and rising in an inflationary environment, one way to insulate yourself is to have your bond mature to reinvest at a higher and rising rate. So this isn't a bulletproof strategy, but being mindful of your bond duration and or maturity, and being sensible about credit risk. And it's hard to envision a world where treasury yields go much lower. I think the 10-year today is somewhere around 140, which is kind of a sign of how much the market might believe in inflationary pressures. It's not really signaling to me that we expect inflation to be long and extended. Yeah. But also to keep in mind that the Federal Reserve through COVID, I looked up this stat the other day. The Federal Reserve before the Great Financial Crisis had a balance sheet of like $900 billion. And fast forward today, I think it's $10 trillion. It might even have been $19 trillion. It was something absurd. Yeah.
It's
so
it's going to 10 for sure.
Yeah, it's definitely somewhere around 10. Which is wild to think about in 10 years, 12 years time, that the Fed has expanded their balance sheet that much. They are slowly starting to taper some of that activity. They've been buying 120 some odd billion dollars of asset purchases a month, mostly treasuries and mortgage-backed securities, to keep long-term rates artificially suppressed, which ironically creates asset inflation and makes stocks more valuable and bonds more valuable and things like that. So as that gain slows or stops, someone else has to step in and fill that vacuum, which I would argue, if no one does, that would create downward pressure on inflation and rising prices. So that's one of the reasons why I think it's just as likely a scenario that we see less inflation, if not deflation, as we do see runaway inflation higher.
Sure thing. But to really just quickly recap today's conversation, I mean, we talked about inflation, why it's here, ranging from supply chain issues to labor shortages and that great resignation where we're seeing a ton of people quit their jobs. We talked about how hyperinflation isn't necessarily going to be present, even though people like Jack Dorsey, CEO of Twitter and Square, are saying so. Then we also discussed, hey, when it comes to asset class and portfolio construction, what are some ways to kind of tackle inflation to benefit or to defend yourself from inflation? But yeah, that's all we have for the first episode of Word on the Street. Please let us know if you all have any questions, and thank you very much for joining.
Thank you all. Have a great day. Great night, wherever you are.
Take care.